right. All right, we are live streaming on YouTube right now, which is on Halen Group.
Awesome.
I'm gonna have to make sure I mute my YouTube first. And we're about to start in 3 more minutes. Let me post it on some of our social media. All right. Of course, when I want to post it on social media, I don't know where I am. Okay. Okay, I got it. So again, you know the drill. This is what, your 3rd time here?
I think so, yeah.
And then we're gonna edit it and then give it a little bit more polished video out. But usually we live stream onto Facebook, but I'm starting to do it on YouTube now. Just wanted to see how it is, and then if anybody wants to respond on YouTube chat, I think it will be kind of fun to see the responses over there. Oh, in case you want the YouTube link, let me send it to you.
Oh, I saw it. I actually pulled it up and then I started hearing reverb and I said, oh, I better close it.
Oh, you're quick. Awesome. Awesome. All right. So I need to find my slides. Let me see, I spent since 10 a.m. this morning. I've been working on my slides, which is so much information. And I'm trying to okay, I need to cut it down. I shouldn't be talking so much, but I'm just getting really excited.
Yeah, well, you put a lot of work into this. And you have a lot to share.
A lot. All right, so let me go ahead and share screen right now. Let me know if you can see my screen.
It says you started
it's
screen
paused.
sharing, but I don't see it yet, what you're sharing.
Oh, you know what? Okay. Let me see, how do I? Oh, that's great. Okay. I'm gonna share. How about now? Are you able to see?
It still says
There.
that you're, oh, there we go. Yep.
Thank you. All right. So right at 4, that's when I'm able to pull up my slides. So I want to welcome everybody to our Bay Area Housing Market Town Hall. We kind of skipped last month, although I did a live, but I didn't put an edited version of our Bay Area Housing Market Town Hall. One of the main reasons why was that we were just really slammed and then had so much going on. So that's why we really didn't have a chance to do an edited version of that video, but hopefully some of you were able to check it out. But now I just want to remind everybody, go to our YouTube channel. You're already on YouTube, then please do subscribe. We consistently trying to put out a lot of videos. And I didn't even realize that I had done over 300 different type of videos, including some it's like maybe video webinars with other organizations, workshops. And especially during COVID, that was when I started putting out a lot more videos because I just really wanted to share what I've learned with the consumers and also my real estate peers. So I started doing more of these webinars. And today, this is our 36th episode already. So hopefully you guys can continue to support us and subscribe to our channel. And then I look back, believe it or not, my very first video that I did was actually, no, it's not that one. Oh, did I lose that page? Oh, right here. I skipped it. This was August 9th, 2009. That was during our last recession. And I clearly remember that moment because I listened to the radio as I was driving, and then they started talking about, oh, the unemployment rate dropped, so the market is going to recover soon. So I was like, well, just because the employment rate drops at this time doesn't mean the market is going to improve right away. So I went home, and then as you can see, the resolution is so blurry because at the time, our cell phone resolution was really bad. I don't even remember. I think maybe I used a camera or something. And I recorded the video and posted my very first video on August 9th, 2009. That's 13 years ago. And very young, as you can see. But just want to let you know that's how long I've been doing this. And this is how my brain works. Always have something to say about the real estate market. And if you want to follow us and really continue to get more updates about our company, do go to our Facebook page. We always post something about the market, some tips, and also all kinds of information. Or you can go to our Instagram. We have videos and posts and some house hack. And also we are actually doing LinkedIn and TikTok. TikTok is a new thing. And did it go away? Oh, there you go, TikTok. I don't even know if we have the account yet or not, because somebody has my marketing assistant had told me that we should have a TikTok channel, and I'm like, I don't know how to do TikTok. I'm not going to be dancing, and they're like, no, TikTok doesn't mean that you have to dance. So we'll see if we can make it there, but that's something that we're planning on doing. All right, now we have a lot of questions these days. And the biggest topic nowadays, inflation. Literally, as soon as I signed on, Daniel already talked about inflation. So how did it happen? And this is what I think about also during my leisure time. This is only from my own perspective. I just want to let everybody know this is from my own perspective. This is what I think has been happening. I always like to learn from others and also listen to other people, but I also want to come up with kind of my own theory as well and see if it really matches with some other people. So I don't know if you would agree with me or not, but now you can see my train of thoughts here. So in 2020, because of COVID, we obviously printed a lot of money. When you have a lot of money, the money supply will increase. I think at that time, a lot of people already said that, hey, if we keep doing this, we're going to have inflation. But either way, at the time, we have to give a lot of stimulus packages out. So definitely a lot of money being printed. And then also people have been saving so much cash in hand. Now, at that time, also, they want to stimulate the economy. So they reduced the Fed rate to almost 0%. So that all of a sudden, we thought we're in this slump. And as soon as the market opens up a little bit, people start investing and buying because you can actually borrow at a super low mortgage rate. As an example, and I mentioned it before, we have gotten a 2.25%, 30 years fixed rate for our house. You've never heard of that. And I know right now, if those people who are getting over 6%, I'm sorry, but we bought it a long time ago. So we saw the opportunity that the mortgage rate has gone down. So we refinanced right away. And also because COVID, many countries had this, they shut down the manufacturing facilities, especially China. As you know, that we import a lot of products from China. So we had this like supply chain issues due to labor shortages and also manufacturers being shut down. So when you don't have a lot of products, obviously it drives up the cost as well. And on top of that, because of labor shortage, then what happens? Well, these companies still need to run their business and they are really trying to look for people to work for them. So now the wage increase. And then of course, early this year, now we have a Ukraine war. With the Ukraine war with Russia, now we have this limited oil supply, and that has caused our gas prices gone up dramatically. I mean, we saw $7 per gallon here in California a couple of weeks ago. It had come down a little bit, but now it's definitely, $6 is very common here. And then on top of that, we have drought issue, and still we have a supply because of drought issue. We have the agriculture has an impact that has also caused some supply chain issues, which caused the food prices to go up. So all these factors really have led to this high inflation rates. So with this high inflation rate, what does that mean? How come the Fed has been trying to do everything possible, right? Well, I don't know if everything possible, but they are really trying to slow it down. But then it seems like the inflation rate is still not slowing down fast enough. Well, one of the reasons is because they can't really take back the money that they have already given to us or to the economy. And they can't really increase the supplies because most of our imports from China still has the zero COVID policy. So the market is still pretty shut down. And on top of that, the Ukraine-Russia war is still a big problem that's causing the oil price to go up. So this is one of the reasons why the inflation rate is still pretty high. It's taking longer than expected to come down. So the Fed's plan has been to fight this inflation as to increase the Fed rate. If they increase the Fed rate, they figure they increase the interest rate, then they will reduce all these investment incentives, right? That's why housing market, most people have, they do need a mortgage, then less people want to buy, then the housing price is not going to go up as much. Or and then they increase the oil supply by releasing this strategic petroleum reserve, which is temporary. So that is how they are trying to control the gas prices to bring it down by opening up our own oil supply in the United States. But again, this reserve is just temporary. It's not going to be long lasting. So once they finish, I believe it's by end of this month, they might have to go back. I mean, our gas prices probably will be going back up. And then another way is like they really need to increase the unemployment rate. So the wages would decrease. If they have the way to do that, right? You will have to instill some fear into the economy, into consumers, so that they are afraid to consume, so that the businesses can't make as much money in that sense, that they're not going to hire as many people. So then they will have more, hopefully increasing the unemployment rate. I just find this really interesting because compared to our last recession, the last recession was truly, it was like so uncontrollable that it just collapsed because of the mortgage crisis. But this time it's like a federal government inducing this recession, and they really trying so hard to tell people how scary this is. I'm not saying it's not going to be bad. I think it is going to be bad because this is the intention of really slowing down everything. But it's just kind of interesting how this recession comes about this time. Okay, so with all this thinking in my head, last week I actually went to Chicago and attended our CCIM annual governance meetings, and I had listened to two speakers. One speaker, let me show you some pictures. This is literally what we've been doing. I represented Northern California chapter, and we had pinned some of the new CCIM designees. If you guys want to learn about CCIM, this is like one of the hardest designation you can get in commercial real estate. Very exciting. They four new designees from California during this time, and they just took a 6 hours final exam, full 6 hours final exam before they were pinned. So it was really exciting to celebrate that moment with them. And then as you see, a lot of people were there. We had a lot of meetings and also conferences. And then it's such an honor for me to be working with like all these elite commercial real estate professionals from all over the country and also all over the world. So the person that I listened to first, it was, well, where did it go? It was Casey Conway. And Casey Conway, he's known for his really detailed economic updates, and he's the chief economist for CCIM Institute. So after listening to him, I have to say I did feel pretty depressed because the economy, from what he's saying, it does not look good. I'm going to pull out just a couple slides for you guys to look at. So here we go. Number one, he said inflation has not peaked. By the way, this is like directly from his slide, so I'm just reading out from his slide. He said inflation has not peaked. It is still at 8.3% year over year for all items and 5.9% core, taking out food and energy, which both food and energy have increased quite dramatically. But the real household inflation rate is called flexible CPI, is over 25%. That sounds so scary. And then he said that food inflation is still rising, up another 10.9% year over year, and 1.3% in July for the food index part of CPI. And unfortunately, this is going to get worse because of the global wheat shortages and US drought impacting the Plain States wheat and corn yields and housing shortages. I think what crazy is that he said, and he's been right on a lot of things. He said the price for a loaf of bread will likely surpass the price for a gallon of gasoline by this fall. So I think, well, we're fall now. I don't really know how much it costs for a loaf of bread right now, but I thought this sounds a little bit scary, but I definitely can see the food prices is going to continue to go up because of the drought situation here. And energy index and gasoline prices dropped in July because of Biden release from the Strategic Petroleum Reserve. And that's the reason why July CPI to come in flat. The energy index dropped 7.7% in July, and he's off a plus 11% increase in June. So this is interesting because I've been hearing a lot of people talking about this. And as you know, right before election, there are a lot of things that not legislators, but they try to implement, right, these policies to help with their election. So there you go. He said that October is right before the November elections. Maybe that's the reason why he was really trying hard to control the pricing. And the final inflation point is the wages. So the labor costs were up 10.8%. We still, as you remember, I think it was last month we did the employment rate, it was 3.5%. So we are still doing, the unemployment rate is still really low. So ideally, actually Federal Reserve, they are hoping to start seeing an employment rate to go up to about 5% in order for them to start easing on the Fed rate hike. Now, people always ask, or actually they always say that, oh my God, next year we're going to be in recession. But if we're looking at the definition of recession, and we have mentioned in our previous episodes, recession happens when you have 2 consecutive quarters of negative GDP, which we already have. So technically, we are in recession already. It's not whether or not we will be in recession, we are already in recession, and how long that's going to last. I don't have an answer. I don't mean to ask this question as if I have an answer. I don't have an answer, but I'm here also trying to learn from other economists as well. All right, so the other person that I listened to, it was super interesting. This is the Gunnar, his name is Gunnar Branson. He's right here. It was right after our global luncheon, global real estate luncheon, with other real estate professionals all over the world. I've met Siska, who's from Guam, and also Shinya-san and Ari-san, they're from Japan. And well, Larry, he is our chair for our International Activities Committee for CCIM, and he's in Seattle. So it was a really great event. And from here, he had shared with us a lot of how other countries are seeing US real estate. And so I mean, there's so many slides. I only, again, picked out only a few. Now, in terms of office vacancy, not only US, but pretty much globally, everybody has their office vacancy increase. So they really had changed quite a bit on how people go to work, not just in the United States, but all over the world. So although US has definitely increased more than the other, 18.9%, while Europe's only about 7.3%. But either way, is that the vacancy rate actually for Europe, if you compare to 2010, is still lower than 2010 Q2 of their vacancy rate. While US, we had already surpassed our last peak at 18.9%. And from their survey, This is also really interesting, is that 81% from their survey said that believe the pandemic has permanently altered culture and live work preferences. And 76% expressed optimism and planned net increase for investment into the US in 2022. And 71% planned, this survey is from 1Q 2022. So I'm going to show you the difference in 3Q 2022. And then 71% planned investment increase into secondary US cities over the next 5 years. And at the time, most of the allocation, they were talking about Atlanta, Austin, Boston, and Dallas. And then the most popular sectors, commercial real estate sectors, are multifamily, industrial, life sciences, and storage. And it's pretty much similar across the board throughout the whole country, including California. And then the biggest concern that everybody has is the climate change, housing, and affordability. Now, 3Q 2022 now, 56 of the respondents believe that the industry was behind allocations for US real estate investments in 2022. They should have done more, and 80% communicated that the impact of inflation and rising interest rates was worse than expected. And that's why whenever our clients ask us, or anyone who asks us, what do you think about next year? We try to learn as much as possible from listening to different economists, and I try to do these monthly housing market update for you by doing a lot of research, putting together slides, and putting together a lot of stats. But at the same time, still, especially the mortgage rates projections, I still see a huge increase from just a couple months ago. And I'm going to show you at the end of this presentation. And so what is the impact? So they actually look at US-based investors and non-US based investors, meaning foreign investors, and how they look at it, right? There are 3 things that I want to point out. Geopolitically, conflicts in Europe and Asia will have increasing negative impact on global real estate investing. US-based investor, 69% of the US-based investor agree, and non-US based investor, 91%. So in the world or in other countries, they actually believe that the geopolitical conflicts in Europe and Asia will have increased negative impact. But then US-based, only 69% of people agree that it's going to happen. And then when we talk about US economy, whether the US will enter recession within the next year, US-based investor, 92% of the people believe that we're going to go into recession next year. But 67% of the foreign investors, only 67% of the foreign investors believe that we will enter recession within the next year. So that is a pretty big difference. It's 25% differences between US-based investor versus non-US based investors. And then lastly is that any future US recession will be less severe than that experienced in the 1970s. That's 72% US-based investors agree, and 74% non-US based investors agree, which is just very small differences. It is kind of important to note this, that Gunnar Branson had mentioned, is that it's not that US is doing great, is because that the whole global real estate or global economy is not doing that great. But in comparison, US market just seems to be doing better than theirs. So it's almost kind of like, he used this really funny real estate analogy, is that, you basically try to buy or invest in the best house on the worst block. So even though it is still a really bad house, but it's better than most of the houses over there. So this is kind of like how foreign investors are looking into the US market. Although, as you know, US currency, I don't know if you know or not, but US currency have been really strong. So it's actually more expensive for the foreign investors to come in and buy US real estate or US products. Okay. So there's a shift in expectations. The gateway cities will maintain their preferred status for real estate investment over the next 10 years. Actually, 61% of the surveys investor, they do agree. Gateway cities, San Francisco is considered one of the gateway cities. Secondary US cities will replace gateway cities for priority real estate investments. Earlier, we've mentioned that a lot of people think that secondary US cities they're going to be investing more in the secondary US cities. But now in this survey, it actually says that 51% of the people do not agree that secondary US cities will replace gateway cities for priority real estate investment over the next 10 years. So markets like New York, Boston, San Francisco, they are the gateway cities, and they still maintaining that preferred status for foreign investors to invest. So what are the opportunities? There's limited amount of high quality real estate investments available in the US. So those that move first will have the opportunity to get invested. And then those with strong balance sheets will be able to lever up and act offensively during any market dislocation. I think this is kind of like, so we don't want to over leverage. We always want to have a strong balance sheet, even personally, not talking just a company, but even as ourselves personally, we should always have a very strong balance sheet, have some cash in hand instead of like using up all the cash in different type of investments. And then in terms of the threats, this is one thing I thought I have been worried about, is that the major resetting of cap rates and erosions of value if interest rates stay higher for longer. So this is important because, as you know, commercial real estate is valued based on cap rates. If the cap rate goes up, the value comes down. So they're buying a property at 4% versus a 4% cap rate versus buying a property at 7% cap rate, that can erode a lot of value from the property. And when, especially for commercial real estate, typically you don't get a 30 years fixed rate. So you get about 5 years, 7 years, 10 years fixed, and then you supposed to refinance, right? Or else your loan is due. So in that sense, that if your value has come down, you cannot refinance, that could be an issue. So that was all the slides from Gunnar Branson. And now in terms of like the IMF, they said that they do have a forecast for the global inflation, is that in 2022, the inflation rate is going to be 8.8%. 2023 is going to be a little bit better, 6.5%, and 2024, 4.1%. Again, this is the projections. As I mentioned, we get a lot of projections. We see a lot of projections all the time, and they do change. But this is really good reference point as well, just so that you can really plan for your future, how to invest, and also how do you see the market. So my takeaway with all of this, I have 9 takeaways. So obviously, global slowdown is going to continue into 2023. US currency strengthens, which make it more expensive for the foreign investors to invest here in the United States. But because the US economy in comparison to the global economy is still considered the best house on the worst block right now. So we probably still see foreign investors coming in to invest. And US real estate investing will seem to be a good safe haven for foreign investors to preserve their wealth. And multifamily and residential properties will have the least impact compared to most other asset types. So we just talked about food price increase. Well, do more home gardening. So that's what I've been thinking. It's like, I need to do more home gardening, although I don't know how to garden. Anything that I plant, they seem to die very easily. So I better learn how to do home gardening. Food prices will continue to increase due to the drought. So we should definitely prepare for that, and do invest in clean energy so we can be more independent from foreign oil. We will see more distressed properties in commercial real estate sector because the cap rate increase, property values will decrease, and that will be very difficult for property owners to refinance once their loan is due. And lastly is that, again, I do think that we are in recession already. It's not whether or not we will be in recession, we are already in recession. And if you want to hedge this inflation, I don't know if you know that, I was introduced to this and I was so excited. You can actually invest into the Treasury I bond. It's giving 9.62% right now. So it's only up to October 31st. You can open an account, just type up, I bonds, how to invest in I bond on YouTube. There's so many videos to teach you how to invest into I bonds. If you want to hedge some of your investments, go ahead and try this out. You can also buy some of these I bonds on behalf of your family members. And but it's only, I think it's $10,000 max per person, but still, it's still really good investment if you cannot find anything that yield 9.62%. All right. I'm going to blow through this real quick. I know I already take up a lot of time, but I know I still owe you guys the Bay Area housing market stats. I just had so much information to share with you because I went to the conferences. So bear with me a few more minutes. Now, always comparing 4 counties, Santa Clara, San Mateo, Alameda, and Contra Costa counties. And we look at the months of inventory. We've been having, consistently going up on the months of inventory to peaked at July. I think we have been talking about, for the last few months, around June, we think the market's going to slow down. The summer is the best time to buy. And July, now that we look back, July was truly the best time. There was pretty much no movements at all. 2.1 is not that bad, but still there was just so little movement at the time. I do know that a lot of buyers were able to get really good deals. October, we have not had a full month's data yet. Right now it's at 3.5. Once we finish out the month, we might have a different numbers, just like September. Last month we looked at was 4.7, I think. But now that the whole month was over, it came back down to 1.7, which is much less than July. And then in terms of the median days to sell, we have come down a little bit to 18 days on the market. And then in terms of how competitive it is, it's just right around asking price right now. Now, Santa Clara County, we're talking about number of listings withdrawn or canceled. And as you know, that around May, all of a sudden we saw this shoot up numbers of listings withdrawn or canceled because everybody was just so shocked about the market change. But in September, we start seeing a little bit less listings being withdrawn or canceled. And then list price decrease, same thing as you see list price decrease. Santa Clara County, we see 561 compared to 688 listings last month. We do have a little bit more still in San Mateo County, but we do have less in Alameda County and also Contra Costa County. We definitely see a uptick on activities as soon as the summer was over. In September, we saw quite a bit of buyers came back onto the market. Not a lot like the beginning of the year, don't get me wrong, but it was not, I almost want to use the word dead in July because there was really, even we had open houses, sometimes nobody even come in, but then now September came back and the market definitely has come back a little bit. Transactions fell through. We also have less transactions fell through in September compared to August. And then in terms of the median price range, Santa Clara County has come down from 1.65 last month to 1.58 million. San Mateo County, it actually gone up a little bit from 1.74 last month to $1.8 million. And Alameda County from $1.2 million up to 1.215. And then Contra Costa County from $875,000 did go down to $835,000. And in terms of offer, the battleground, these are some of the offers we've seen. We do see it's really, really, really extreme right now on some of the markets. Depends on the locations. If you have really good locations in terms of good school district, it is close to offices like Cupertino, Sunnyvale, but you have to have good schools. It doesn't have any deficiency as if you are on a major road, you don't have a bad floor plan, then your property still have multiple offers and can still sell above asking price. But if your property have some kind of deficiencies, bad floor plan, missing a garage, or the floor plan just doesn't make sense, and if your location is not as good, then all of a sudden your property just sitting on the market for a long time. So we definitely see quite a drastic difference between those type of properties. So as an example, look at, let's see, Sunnyvale, Yeah, there you go. 41 offers for this property, single family homes, and it sold just below $2.6 million cash offer. And for that property, the highest wasn't even 2.6. The highest was actually 2.68, but they took a cash offer because they didn't want to take the risk of taking a financed offers. But then you've seen that, like, for example, something like a single family in central San Jose doesn't have a very good school district, even though they received numerous offers because of the less ideal floor plan. All the offers are below asking price. So these are some of the examples for you guys to reference and to understand how the market works right now. All right. And lastly, before we go to talk to our speaker today, these are the mortgage projections from different agencies. And the one that I kind of blow my mind right now is Mortgage Bankers Association. It just seems like their projection is still so low compared to, even though they had already gone up in terms of like comparing last month projection to this month, their mortgage rate is still really low. Same thing for Freddie Mac. Although I have to say Freddie Mac, this one is from July. So I guess they were still a little bit behind, but Fannie Mae in September, their projections is like high fives. But what we can see is that they all believe that about 2023, 3Q, 4Q is kind of coming back down. National Association of Realtors seems to be the most in line with what's happening right now. 2022, 6%. They believe that 2023 1Q is going to go up to 6.5%. And then 2023 2Q, 6.4, and 3Q, 6.3, and then 6.1% on the mortgage rates. All right. What do you think now, Daniel? And Daniel is our repeated guest on our show or on our webinar. And you have so much knowledge and you do loans for a long time. Would you like to actually introduce yourself first? Let me stop share.
Yeah, so my name is Daniel Gatt. I'm with Synergy One Lending. I've been a mortgage lender since 2005, so 17 years doing residential mortgages. And I've been working with you for at least 10 of those years, which has been phenomenal.
Yes, during the last recession, for sure.
Right. And this was a great explanation. I want to add that one definition of inflation that I heard is when there's more money than product. And it kind of lines up with what you were saying, that, you know, with supply chain issues and the government printing money, well, you have less product and more money. And so that is how we ended up in this inflationary period. And then there's other topics I won't get too in depth about, but if you ask Saudi Arabia, they'll say our prices of gas are high because we don't invest in refineries in the United States, and that if we did, we could be paying half as much. It's had nothing to do with the Russian war, but it depends on what who you want to believe, our media or the people selling us gas from the Middle East. But
exactly. I mean, if you talk to a German, it's a completely different story too. For them, their gasoline is really heavily reliant on the Russian oil. So right now, for them, in order for them to survive, they really, really, according to Gunnar Branson, he's saying that Germany now have to really invest into clean energy, and this is actually really towards the future of the world. Whether US is going to be going towards that direction as fast as the European countries. So we have to see, but it is definitely the direction that's going.
Yeah, Europe definitely has to make faster moves. I mean, they were heavily reliant, whereas we were getting about 10% of our oil from Russia. So for us, it really shouldn't. I mean, it depends on what we believe we're being told, but we believe that our gas prices are doubled or tripled because of the Russian war. If only 10% of our oil comes from there, that's hard for me to comprehend, but we won't get into conspiracy theories. Let's talk mortgages. Let's talk lending. And,
Sounds good. Well, I guess like one of the reasons why we brought you here is that obviously with the interest rate hike increasing so fast, every 2 weeks, we're just like, oh my gosh, increase again. A lot of buyers are feeling very, very uneasy. So how should they go about this? Are there steps that you can actually share where, they kind of ease their minds so they're not as worried?
Yeah. So, well, one thing to keep in mind is that no matter who you talk to, we all believe that eventually we're going to get out of this inflation, whether that's Q1 2023 or Q4 2023 or Q1 2024. It's inevitable that the Fed is going to take the proper steps to get us out of the inflationary market. And historically speaking, every time we've had inflation, interest rates have gone up. And every time we get out of inflation, interest rates come back down. So while it can be intimidating to look at what rates are today versus even 12 months ago, it's important to know that there will be opportunities to refinance, to have better rates in the future. And that, this may be a time that is less competitive to buy, because there's a lot of people that are maybe waiting for the rates to come down. But when they do, all those people are going to come back in the market, and that's going to shift housing prices back up, I think, is when we see much more competition in the market. But it's really important that when you get pre-approved, to understand from your lender all these details. Like we talk in the lending world about debt to income ratios. So these are DTI ratios. It's a very important matrix. For example, jumbo lending, which is larger loans, typically, what you'll see a lot of in California. Jumbo lenders typically say that you can have a maximum debt to income ratio of 43%.
Sorry, I'm going to stop you right there, just in case we have people who don't understand what debt to income ratio is. Do you mind to go over real quick, how do you guys calculate the debt to income ratio?
Great question. Yeah. So debt to income ratio is going to be your proposed housing payment. So your mortgage, your property taxes, your insurance, and if there's an HOA, your HOA dues as well, plus any revolving debts that show on your credit report, meaning minimum payments on cars, minimum payments on car leases, car loans, credit cards, student loans, personal loans, any type of loan that's going to show up on your credit report. We add all those minimum payments to your proposed housing payment and do that as a comparison of your taxable income. So if you're W-2, taxable income is very simple. It's your gross income. If you're self-employed, it's a little bit more complex, but the easiest description would be, it'd be your income after your expenses that you write off on your taxes. So now understanding the debt to income ratio calculations, if you get pre-approved with a lender and the lender says, hey, you're good to go, I think it's really important to ask your lender, well, what's my debt to income ratio? And this is not something that I would have ever in the past said that a consumer needs to know this, but in this market, we do. And the reason why is that if the lender says, well, you're at 42.9%, great. That means that you need to be really on the watch for where interest rates go. Because if interest rates go up by 1/8% next week, and you haven't yet locked in a rate, you haven't found a house and locked in a rate, you may not qualify anymore for the maximum that lender qualified you for. But if they tell you your debt to income ratio is 35% or 38%, you have a little bit of wiggle room, that rates can go up and you can still be fine. And even if you don't want to try to figure this out on your own, another recommendation I would have is every time you see a place online or that your real estate agent shows you a place and says, hey, do you want to go check out this place? Before you go see the place, check in with your lender. Call your lender and say, hey, where are rates right now? Can I still afford this maximum number that we had discussed previously, or is that number shifted? So I think it's important to understand that a pre-approval is not a static document. It's a dynamic document. It's moving as interest rates move. So a lot of times I get asked, how long is the pre-approval good for? Now the answer is really, depends. From a banking standpoint, we would just say 90 days. But the reality is it depends on where the interest rates are and if anything's changed in your financial picture since the time that we verified your paperwork. In other words, if you lost your job or changed jobs, if you went out and bought a new car after you were pre-approved, these are all things that can impact what you're actually going to qualify for at the time that you're trying to buy a house.
So let me ask you this question then. For example, sometimes some people, they have an underwritten approval letter already because, we're so used to that. Oh my gosh, it's so competitive. You probably want to go in very strong. A lot of people have been making offer without the loan contingencies, and they had gotten an underwritten approval letter. But doesn't mean that now you can just make an offer with no loan contingency because the interest rate might have changed, right?
Right. That's why it's so important to check in with your lender and just to understand that what is an underwriting approval. There is no mortgage approval that is 100%, even an underwriting approval. An underwriting approval is a conditional approval. And what do I mean by conditional? Meaning that they can redact that approval if, let's say, 5 days before you're supposed to close on your purchase, you terminate your employment. the bank has no obligation to give you that loan that they underwrote you and approved you for. They'll say, no, based on 5 days prior to closing, we cannot deliver a loan to you anymore because you're not employed any longer. So
and they check your credit report again.
They check your credit as well. So that's another thing. I joke with clients all the time. I say that, don't go out and buy a Lamborghini right after we underwrite you and then before you finish buying the house, because let's say you did and there's a $4,000 a month car payment. Well, now the bank has to include that in your debt to income ratios. And even if you were approved up until this is 5 days before closing, the bank finds out you bought this car. Now it shifts your debt to income ratios. You may not be approved anymore. So it's important to understand that it's always conditional until you get keys to the house. The minute that we fund the loan and it closes, then there's no conditions. If you quit your job, you change jobs, you buy the Lamborghini, you do whatever you want, the bank has no recourse. It's your house, it's a done deal, it's your loan. But until you have that loan funded and you have keys to the house, it is a moving target. So it's important to check in with your lender consistently. Where are rates, so that even if you've been underwritten, that you can make sure, well, based on today's rates versus yesterday when I was underwritten, do I still qualify?
Right.
That's a good question to ask your lender.
Now, this is like not going out and buying something expensive is not because of the interest rate hikes. Anytime you are applying for a mortgage, even though the interest rate was very low, you still should not be buying anything extravagant or expensive in the middle of escrow. So hold on to that desire to buy that car right now. We do remind our clients sometimes, like, hey, don't go out and buy all these furnitures or a car during this time. If you do have to get pre-approved again. But if you're in the middle of the transaction, then you have to be very careful about that. Now, with the current interest rate hikes, do you see that banks are becoming more stringent in terms of the guidelines? Not just the debt to income ratio, but I'm talking about like maybe increasing. We need more reserve to see that in their bank account, or they need more documentation.
Yeah, so that's a great question. What I have seen is that some of the traditional banks that were doing maybe 90% loan versus value, so they're lending 90% of the value of the house, some of them have cut back to 85%. So that's on one end where we see it, that banks are tightening up their guidelines a little bit. As far as reserves, I'm seeing that those guidelines I haven't really seen change from over the last few years. But I will say that, for example, agency loans, which are loans sold to Fannie Mae or Freddie Mac, Fannie Mae and Freddie Mac have something called AUS, which stands for Automated Underwriting System. Every bank in the United States can sell a loan to Fannie Mae or Freddie Mac up to the conforming loan limits. These AUS systems, which are called DU and LP, depending if it's Fannie Mae or Freddie Mac, they generally have, as long as I've been doing this, if somebody has decent credit scores, I've seen these systems approve people to somewhere around a 50% debt to income ratio is what the maximum these automated underwriting systems will allow. I've noticed in the last few months that the systems are not as easily approving people to these higher ratios. So I believe that Fannie Mae and Freddie Mac may have changed their algorithms in these automated underwriting systems that the banks use. And it's possible that they've made them more stringent. And I recently had a client that I couldn't get approved at above 36% debt to income ratio with the automated underwriting system. And it turned out we had to use a different type of loan, a FHA loan, which is Federal Housing Administration, which did allow for her to be at a higher ratio in order for us to find a solution for that client. So I think it's important that you're working with a lender that looks at all your paperwork, runs the AUS system, sends your loan into underwriting, does all of these steps so that by the time you make an offer and you go through all that effort, you know that you're going to make it to the finish line without any bumps in the road from the lending side.
That is actually a really great point, is that especially right now, because the market fluctuates so much, you really cannot just go in like, oh, okay, let me just walk into any bank and then talk to a loan officer. You have to work with somebody. Even I'm talking about like if somebody wants to walk into that bank, you have to work with somebody who know what they're doing, who maybe can ask for exception. And for example, Daniel, you've been in the industry for 17 years, right? You said,
yep,
which is actually the same as me, 17 years. And you have so many connections with so many banks out there. So you're a mortgage broker and also a correspondent lender, or are you direct lender?
Direct lender, mortgage broker, and I have friends that work at most of the banks out there. So I feel like I'm a one-stop shop with all the connections.
Yes. So you can actually figure out, okay, with your this scenario with this client, if this bank doesn't work or this guideline doesn't work, I can change it to another one. And or maybe you can actually talk to underwriting department and then get certain kinks out of this file. I think it is really important because if the loan officer does not know how to work with the underwriting department, the failing rate is high and you can lose your earnest money deposit.
Yeah, and I will say in the 17 years I've done this, I've never had a deal fall apart because of a lending issue. Certainly we've had to make shifts every once in a while, every once in a blue moon, make a quick shift to a different product, but we've never failed because we do our due diligence up front. And my team and I have a knowledge base, 17 years of doing this and being a top producer. We never guess on anything. If we're not sure, we go to underwriting. We want to be 100% sure. We want to make sure that if we say you're good to go, you're going to get keys to the house.
Mm-hmm. Yes. And again, different banks have different guidelines. This is one of the reasons why people come to you, because you work with how many banks would you say?
Right now, over 20.
Over 20.
Yeah, quite a few.
Yeah. So you work with over 20 banks. So and then each bank have different guidelines. So you're going to fit each person into a different bucket to make sure that they can get qualified. And then your job is to go over all the paperwork first. So I'm trying to kind of also explain how realtors work with loan officer. As a buyer's agent, I always work with a loan officer to make sure that, that's my first question too. It's like, have you looked at their debt to income ratio? What is it? I want to know the loan officer knows. And believe it or not, I have talked to loan officers and they could not give me that number. And they were like, don't worry about it. Everything looks good. I was like, well, what is the debt to income ratio? And if they cannot tell me, then I don't feel confident to let my clients know that, yeah, I think your loan is going to go through. I mean, I can't even say that, but I need the loan officer to give me that confidence. And that's really important too, because when you make an offer, your loan officers need to be very responsive, because listing agent can also ask that same question. Have you really looked at all the files? Did you run their credit report? What is their FICO score? They may not, I don't think you guys can tell the agent what is their FICO score, but they want to hear that how well qualified they are. They need to instill that confidence in the listing agent.
Absolutely. And I think that, in general, this is one of the advantages of being in my position. Our job is called a mortgage banker, where we don't work at a bank, but we are a direct lender and we also broker loans. 100% of my business is referred by real estate agents. So if I fail at what I do, I also expect that I'm not going to get referrals. Whereas somebody is sitting, and this may vary obviously from person to person. I'm not trying to single out everybody who is at a big bank, but if you sit at a big bank behind a desk and everybody that walks in the door is an instant client of yours, you don't have that same responsibility that your referral source is going to disappear because your referral source is the bank you're sitting behind a desk in. So I like to think that, while there are loan officers, and there's ones that are in my position too, that are mortgage bankers, that maybe guess or, get half the paperwork from their client and say, yeah, you're good to go. Those of us that want to maintain a perfect record, and I have a Zillow page with 100% 5-star reviews. If you want to maintain that, you have to be 100% right. You can't be wrong ever. And you have to deliver. And it's so important because the person I'm working with, they're making the biggest financial decision of their life to buy a home. And I can't imagine, after all the stress of looking at multiple houses and making offers and then finally getting an acceptance, I can't even imagine the stress that somebody would go through if at that point, then they found out that their pre-approval wasn't worth anything and that they can't close on the house because they don't actually qualify. So I think it's really, really important to if you're interviewing multiple lenders, which I think most buyers do, is really get a feel for what is that lender's knowledge base. Look up information on the internet, quiz them, and see how well they can respond. Because it's not only about the lowest rate, because the lowest rate with somebody who can't deliver a closing doesn't necessarily help you in any way. So I think it's more important to say a great rate and somebody who really understands what they're doing and can deliver great service is the best place to go.
Absolutely. And I do want to go over a little bit about the steps, how to actually get this pre-approval process, just in case somebody have never done it before. But before we go there, I also want to mention and emphasize how important it is not to just go onto any of these online lenders. Not saying that they're not, not saying they're not good. It's just that is that my phone or your phone?
Not me.
That's interesting. I don't know why I have, maybe it's me. Sorry, excuse me. Somebody's calling me from a website. But I was trying to say is that these online lenders, they might be good to do refinancing, but when you're doing purchase, it's very time sensitive. And if you have promised the seller that you're going to close within 30 days, you better be able to close within 30 days. If somehow you cannot, you are begging for extension from the seller. And if the seller somehow got a better offer than yours, he can easily just say, no, I'm not going to grant that extension. You need to get out. I'll take your earnest money deposit and I'm going with a higher offer. I'm not saying it happens a lot, but just in case it happens, then you just don't want to go with any online lenders because they typically they're not as responsive and they don't understand the speed of our market as well.
Absolutely. I think that's so important, is that you have somebody who has local knowledge and a great reputation, and is, not just somebody who came into this industry in the last 2 years because they heard it's easy to make a living in it, which it was in the last couple of years, but not anymore. And the good thing is this market's, we're seeing a lot of people that were fly-by-night lenders leave. And those of us that do this as a career, we're happy to see them leave. But, it's important that you have great representation, both with your real estate agent and with your lender if you want to be successful.
Well, sorry, just because you brought that up, if people always think that real estate is so easy, but they have no idea until they're in it, right? And then realize that there's so much more work to do behind the scene. So anyhow, I just thought to throw it in because you brought that up, that people always think, oh, it's such an easy job. You guys make money so easily. I'm like, oh, you have no idea. It's like the most stress. Well, not the most, but it's really, truly stressful. And I don't know how many times I've seen that happening when people coming into the industry and then just, stress out. But anyhow, so go back to the steps. Like, what are the steps that they need to take from filling out an application first or talking to a loan officer? How does that process look like?
Yeah, so I think the best way to handle it is a conversation first. So like when I'm introduced to a new client, I'll usually try to set up a phone call with them. And I try to understand their needs, kind of any background story that needs to be told. And then I'll generally ask the new client if they have time for a little Q&A where I could try to figure out over the phone a ballpark of what they qualify for. And if the ballpark numbers look like, hey, this is in the right range for what you want to do, then we can shift to the next step of putting together paperwork. So I'll start with a Q&A. And then if all the numbers look good with the Q&A, I'll generally send my clients a link to a secure site where they can fill out an application, and I'll ask them for all the appropriate documentation, which can vary from tax returns, W-2s, paycheck stubs, bank statements, if they own other real estate, mortgage bills, property tax bills, insurance bills. Every detail of your financial life is basically being asked for. And if you're working with a lender that doesn't ask you for all this paperwork, they just say, well, tell me what you make and let me run your credit. Let me tell you already, that's a terrible idea to trust that that's a pre-approval. That's not enough information. It's not enough detail. And when you're buying the house, the underwriter's not going to just ask you to tell them what you make. They're going to ask for the documentation. So make sure that if you're working with a lender, that they ask you for all these kind of documents, which is truly not a fun process to put it all together, but it is what is necessary to ensure that when somebody tells you you're pre-approved, that they are telling you that based on the same documentation the underwriters are going to see. And furthermore, these days, as Helen pointed out, a lot of people want to get underwritten. You want to get an underwriting approval. So generally speaking, the process is pre-approval, which is myself or another loan officer doing the review of your paperwork and saying what what we believe to our best knowledge you'll qualify for. And then we need to turn everything into the underwriters, and they're going to either confirm that we did our numbers correctly, or they'll confirm that we didn't, and that these are the correct numbers that we should be using. But ultimately, to do an underwriting approval, you'll need all this paperwork. So it's really important that, I've had people that are hesitant about putting together the paperwork just because it's a little bit of pain in the rear to get it all together. But it's ultimately for your protection. It's not because I want to hassle you for the paperwork. It's because I want to make sure that whatever I tell you is 100% accurate, and that you can go make offers based on my information that I'm providing you, that you can secure the lending for at the end of the day.
That is the biggest complaint we hear from our clients about the paperwork. But like you were saying, the paperwork is absolutely necessary in order, but there are ways to reduce some of the paperwork, especially if they have a lot of in and out of deposits and withdrawal, or if they have some other gift money coming from outside of the country. Because if you have some gift money from outside the country, then there's going to be another layer of documentation you will have to provide, correct?
Correct. Yeah. It's, every file is different, right? As far as what paperwork is needed. But if you have gift funds, it's one thing to have gift funds coming domestically. It's another thing if they're coming internationally. And it's another thing depending on the bank's guidelines. Some banks have a guideline that say if the gift funds are wired directly into the title company, then all we need is a gift letter form and a copy from the title company of the wire receipt showing that it matches the name of the person who said they're sending the money. Other banks have guidelines that say, no, we want to see the transfer of the money coming out of the donor's account. And if they're in an international account, maybe they also want to have that translated by a certified translation company. So there's all these multiple layers. So really, the earlier you can start the conversation with your lender, as soon as you have that inkling, I might want to buy a house. That's the exact moment you should start talking to a lender, because it's not when, hey, I just found a house, or I've been looking at houses for the last 3 weeks, because there may be some obstacle or something that we find out in the pre-approval or underwriting process that might have some time constraints for you to sort through. And so the earlier you can start that process, really the better off you're going to be, and the easier it's going to be once you find a home and have an accepted offer to get through the formal process. I
cannot agree with you more, because honestly, lender and us, we are partners in a transaction, right? And sometimes our clients would say like, hey, I don't need to get pre-approval. It only lasts 3 months. So I want to find a house first before we go to talk to a lender, or they have already talked to a lender. They just don't want to get a pre-approval yet. And from what they think is that pre-approval is only going to take 2 days anyways, but it's a lot more than that. It really, you need to take, looking at all the paperwork or even submitting into underwriting can take a week, 2 weeks sometimes. So just be prepared, because in case your file is not as clean and straightforward, at least you're prepared ahead of time how to handle it. Some of our clients, for example, like we said, have a lot of in and out of the money from international or within domestically. Maybe you need to have the money seasoned first for 3 months before you start the process. There are things that you do need to be aware of before you really make that decision to purchase a property, because you need to understand the timeline.
Absolutely. And that's why, in this 3-month thing with the pre-approval, the reality is that as long as nothing about your finances change, meaning your job and employment's the same, your liabilities are the same. You didn't go out and buy that nice car before you bought the house. And so your liabilities and income, and then your assets too, as long as nothing negatively is impacted, right? If your income goes up, great. If your assets go up, great. If your liabilities go down, great. There's no reason for you to believe that in 6 months or 12 months after you've been pre-approved, that the numbers won't be the same. And generally speaking, for my clients, I usually will tell them that I will write pre-approval letters for them for up to 12 months after I've pre-approved them, with the understanding that if they have an accepted offer, we'll have to pull a new credit report and update the paperwork. But that we have to have an understanding that I'll do that for 12 months as long as we have an understanding that there's no changes to any of those, negative changes to liabilities, income, or
credit
assets.
score.
And the reason I do that is because there's no reason that what you qualify for today won't be the same in 12 months if nothing's changed.
Yeah, unless for some reason, your credit score, because you had gone up to have so many inquiries on your credit report, and then your credit score drop below certain threshold, and that can affect your interest rate even that you can qualify for.
Right. So I think it really depends. Like the client that has a 38% debt to income ratio and a 800 credit score, I'm not so concerned. If their credit score goes down 20, 40, 50 points, and they're still going to be fine, and interest rates go up by 1%, that person's still going to be fine. The person who's on the ragged edge, again, I'll give them the same advice we talked about earlier, which is check in with me every time you're interested in seeing a house. Check where the rates are. Let's make sure that the numbers still work. I generally provide all my clients with an Excel spreadsheet that I created that they can.
Oh, I've seen those Excel spreadsheets.
Yes.
Very detailed.
Yeah. And I think it's so important, right? Because then the client I'm working with can see what their own debt to income ratio is. All they have to ask me is what's the rate. They plug it into the spreadsheet. They plug in the purchase price, the down payment. If there's HOA dues, they plug in a few parameters and it'll tell them what their debt to income ratio is. And it'll even say on the spreadsheet what the maximum is allowed to be for their particular scenario. So I try to find tools and ways to make it easier for my clients to understand, on a day by day or week by week basis with all these rate changes happening. How does it affect their ability to qualify? And more importantly for them, even probably, how does it affect their monthly payments?
Yeah. And so after they get the pre-approval from you and then they make an offer, they got it accepted. What happens after that?
So as soon as that happens, my team reaches out to the title company. We get all the appropriate paperwork from the title company. We order the appraisal day one, just to make sure that we're moving all the pieces of the puzzle forward very quickly. And then we'll reach out to our client.
Why do banks need appraisal? Just in case somebody asked that question.
Yeah, great. That's a great question. So the banks, want to understand. Banks lend on what they call LTV, which is loan to value. And value to the bank is the lesser of the purchase price or what a third-party appraiser appraises the property at. So in many cases, they're the same number. And that may seem strange. Why is it that a random offer would always be the appraised value? This can get into conspiracies, but long story short is appraisers have a copy of your purchase contract. My personal opinion is that a big part of their job is to justify based on comparable sales. Is the price you're paying a justified price? If it's not, if comparable sales are all like $100,000 below, they're not going to just arbitrarily say that the price you're paying is the appraised value. If it's plus or minus like 10, 15,000, they probably will come in right at the price that you're paying. If some of the comps are slightly more, some are slightly less, it makes sense. And again, if all the comps are $100,000 more, then and when I say comps, I mean comparable sales that are recently sold in the same neighborhood, usually within a 90-day period. And in a market where we have a lot of movement like this, the appraisers are really trying to say, well, let's use comparable sales that are as recent as possible, because 90 days ago could have been a very different market than today even. But the bank wants to know that an independent third party believes or what value they believe the property to be. And then they'll lend you, if you were doing 20% down, for example, then it's an 80% loan versus value or loan to value, LTV. So the bank will say, okay, we want to make sure it appraises, and whatever price it appraises for will still, the lesser of the appraised value or the purchase price, we will lend 80% to that. So it's important for the bank to understand that, it's the bank's way of knowing that, are you getting a market price for your house, or are you overpaying or underpaying? They're happy if you're underpaying.
Yeah, absolutely. And have you seen like for the same property, a couple of different appraisers, they come back with a very different number?
Yeah. So the first time I saw this was over a decade ago, and I was doing a loan for a friend who lived in an affluent area, and we had two appraisals done. They came in, one was like 2.3 million and one was 2.7 million for the same house, done on the same week. What I learned then was that there's not necessarily consistency between appraisers. So it's important to understand that if your appraisal comes in low, for example, while that may affect your lending ability, what the bank's willing to lend to you, it doesn't necessarily assure you that the value is low. It could be just an appraisal is that appraiser's opinion of value. There's more than one opinion though, and out there. And I truly think that if you hire 10 appraisers you probably will come up with 3 or 4 values for the same house.
Absolutely.
And that's just because it is an opinion of value. So we tend to work with AMCs, which is appraisal management companies that hire local appraisers that have local knowledge. So we don't want an appraiser from San Francisco coming into San Jose. And same thing, we don't want somebody from San Jose maybe going to Berkeley. We want to have somebody who's a Berkeley appraiser that knows that area the best to do the Berkeley appraisal. We want a San Jose appraiser to, specific to Central or Northern San Jose to the specific neighborhood. We want somebody that's really, really well trained so that we avoid these kind of issues where maybe we have a low value because somebody doesn't understand the nuances of, well, if you cross this particular street, values of homes go down 20%, but if you're on this side, they're 20% more. We want somebody that has that kind of local knowledge.
Yeah, and to give an example, years ago, I had an instance where two appraiser appraising the same property, and this property is only 1 block from Main Street, and this property is an investment property, and one appraiser actually said, "Oh, this is great location. It's only 1 block from the Main Street. Awesome." Gave it extra value for that. The second appraiser said that is not good. And that's his opinion. He's like, it's not good to be 1 block from the Main Street. That's the difference between appraisers, that they are so subjective. It is, like you said, is their own opinion of value. And they can see something that one person think that this whatever remodeling is great, and the other person would think that this remodeling is just it's not that great. So unfortunately, it does happen. Sometimes appraiser don't appraise the property at value, but just understand that if you have, like you said, 10 of them, I think we're going to have all 10 different values, or maybe at least 7 different values.
It's very possible. That's what I've experienced over time. And, it's an opinion of value, and we hope that we get, this is why we choose to work with, we choose the appraisal management company we work with. This is all to do with regulations that were put in place in 2009. Prior to that, a mortgage lender would just call an appraiser that they already have in a relationship with and ask that appraiser to go out and see the property. Now, banks and mortgage lenders order appraisals through AMCs, which are third parties, and they randomly select the appraiser from their panel of approved appraisers to go out and do the job. And the reason for that is to make sure that there's no influence from the mortgage lender to the appraiser, so that there's no funny business and that you're getting a fair assessment of the property. So, going back to what is the process, so that we order the appraisal right off the bat, and then my team will generally reach out to our borrower and go over the latest terms. Now that your offer has been accepted, we can lock in the rate, which is a term we use for saying you can secure this rate all the way through closing, regardless of what the market movements do between now and your closing. If you lock in the terms of this rate, we will deliver on those terms at the closing. So we provide our clients with all the different rate options, with paying points, not paying points, and points are an additional fee you can pay a bank to get a lower interest rate than the market rate they're offering. So we try to give all the different options to our clients. And then also we go over their file and say, okay, we underwrote you 2 months ago. Well, we need to update paycheck stubs, update bank statements. We need to update a few other things. And we advise our clients of what they need to start doing too, like start shopping for an insurance policy for your home to insure your home. And when you make your earnest money deposit to the title company, let us know when it clears your bank account. We'll need to have a transaction history showing it clearing your account to give to underwriting. So there are certain, we kind of give direction as to what are the next steps. And we try to be patient too, because we understand that on your end, the real estate side, you have a ton of paperwork for your client as well. And the escrow and title companies are going to have a ton of paperwork too. So there's a heavy process when you first get your offer accepted, because everybody's coming at you for paperwork. But it's not really that bad. You can get through it in a matter of a couple of days, and then you have a kind of quiet period while you go through underwriting, wait for the appraisal to come back, and we try to make the process as smooth as possible, make ourselves available as much as possible, so that when somebody's going through this, what could be a stressful process, we want to make it feel like, well, at least I've had the answers to every question I have. So how stressed can I be if I know everything and it's available to me? And that's why we love partnering with you too. We know that your clients are very well informed from the great work that you do in your team. And And we try to match the same thing on our end with the lending support.
Yeah. Exactly. I mean, that's why it's so important to find a really good loan officer partner. And because, like you said, the first couple of days, or we kind of give our clients the first 5 days, like, hey, you're going to be focusing on the loan process, the loan paperwork. We're going to have our paperwork, but we try to give it to them after so that they can really focus on one thing at a time. I'm one of those people. I cannot be like, if you just give me everything, I get so overwhelmed. So I like to tend to do that for our clients to like, here go, focus on the loan first. And then after 5 days, that settled down, we're going to give you other stuff to do. And then the escrow company, we kind of try to pace it for our client. Now, after the underwriting, they receive the appraisal report. If the appraisal value is good, then they move towards the loan approval. There's this thing called closing disclosure. How does that work? The timeline and all the way when they need to put in their down payment and closing.
Yeah, so the closing disclosure is when the bank is essentially, I'll back it up a little bit first. First is a loan estimate, which is something that as soon as you have an accepted offer, within 3 days, the bank is required to provide you a loan estimate, which is an estimate of your closing costs. I'm going to say this as bluntly as I can, which is most of the time these loan estimates are going to be completely wrong. And the reason for that is that the bank is not choosing the title company. The bank's not choosing the escrow company. We don't know how much the prorated property taxes are, the transfer taxes, and other costs that are not associated with our bank. So we have a system that will input these numbers that are automatically generated, but they're not necessarily the numbers that are associated with your transaction. So what we do is we send out this loan estimate. We advise our clients that they're not binding. It doesn't require you to accept these terms, that you signing these initial disclosures are simply you acknowledging receipt. Then we send this loan estimate that we had you sign and acknowledge receipt of to the escrow officer. And we ask the escrow officer to put together a buyer's estimated closing statement. And that way we're starting to get actual firm numbers of what your closing costs are going to look like. By the way, generally I'll ballpark what I think it's going to be long before we even got an accepted offer. And generally these numbers are going to be well within the means of what I ballpark, but we'll get an estimate now that is far more accurate. And then ultimately the bank needs to send out this CD, this closing disclosure. And that closing disclosure should be more matched up with the actual estimate from the title and escrow company. It should be more accurate numbers. It should be really delivering numbers that you're going to be actually expected to deliver at closing as far as cash to close. What are each of the separate fees? This is the final version of any type of estimate. And I still say estimate because until you're closed, that's when you get a final closing disclosure. And the reason
because if you close 1 day late or 1 day earlier,
yes,
that can change because of a property tax proration or interest proration.
That's exactly it. That's why it's still called an estimate all the way up to the end. But from a timing perspective, which was the original question, once the closing disclosure is electronically signed, the soonest you're allowed to sign closing documents, and this is really pertaining to primary residence and second home. This doesn't pertain to investment property. There's no waiting period on investment property.
That's
but
right.
For primary residence and second home, there's a 3-day waiting period. So once you've e-signed that closing disclosure, you cannot sign the actual closing documents, the ones that you're going to sit down with a notary and sign, and these are the official binding documents. Those can't be signed until 3 days later. They don't count Sunday as 1 day, and they don't count holidays, but Monday through Saturday are counted as calendar days that for the 3 days. And it's important to know that because when the lender sends you a closing disclosure, you don't want to just leave it in your inbox for a week because it's prohibiting the lender from being able to get to the next step of actually issuing the closing documents, which are truly your binding documents. Those are the documents you want to make sure that everything's right. If you find a mistake, if your lender tells you sign it, don't worry, we'll fix it. No, don't do that. Not on the final closing documents. Everything needs to be right. If there's anything wrong, the lender needs to redraw the documents because these are final and binding. But so that's the process essentially. It's you have an accepted offer. We order appraisal. We clean up our paperwork. We resubmit your loan to underwriting, even though you may have already been underwritten and approved. Now it has to go back to underwriting now with a copy of the purchase contract, with the appraisal, these other items that need to be signed off. We get everything signed off. Once it's all signed off, we get issued what's called a CTC, which stands for clear to close. So underwriting's telling us, hey, you're cleared to close. and going back to something we talked about earlier, is that even when you're clear to close, it doesn't mean it's 100% done, right? If you leave your job that next day, then you're not clear to close anymore. So it's so important to not change anything about your financial picture while buying a house. But we'll get the CTC, that the closing disclosure may go out before the CTC is even issued. That can happen much earlier in the process nowadays. So it can happen halfway through your escrow period. And then once we have CTC, that's when the bank can draw up the final closing documents. We'll send them to the title and escrow company. The escrow officer will set up a signing appointment, either with themselves as the notary, or they'll hire a third-party traveling notary. And then you'll sign the documents. The documents go back to the escrow and title company. Then they go back to us as the lender electronically. And then we advise you when to wire your money to the escrow company, the remainder of your down payment and your closing costs, which is going to be about 3 days prior to closing. And then generally speaking, depending on the county, we may fund the loan 1 day prior to your scheduled close date, which means that we put the bank's money in escrow. And then the next day, the title company will record and close. And that's when you officially are the homeowner and get keys. And so we walk you through that whole process. We make sure that, we're all about, at least our process is about handholding. It's really just letting you know what to do and when to do it. So you don't have to sit there wondering, am I supposed to be doing something?
Yeah, and it sounds complicated, but trust me, a lot of these things is happening behind the scene. There are a lot of paperwork we do ask you guys to submit to the loan officers upfront. That's why get your pre-approval ready earlier, then you really have a preparation of all this paperwork ahead of time, because you don't want to wait a few days before you can submit your documents after your offer has been accepted. But then there are a lot of things on the back end that's happening with like the underwriting department, the escrow company, and then we try to like work with the escrow company and the lender to provide all additional documents, all that stuff. And we try not to stress our clients more, so they don't really see like, oh, nothing's going on. But trust me, a lot of things are going on the back end.
Absolutely.
Yeah, but thank you so much, Daniel. This is like so informative. We're going back to basic, but we do know that there are a lot of people do want to know, like, how do you get pre-approval? Right now, I know there are a lot of interest rate hikes, but essentially the process is still the same. You just have to be sure before you write an offer, do a pre-approval again with your loan officer, double checking your numbers to make sure that your debt to income ratio did not go past that maximum allowable debt to income ratio. But if you have any questions, obviously, feel free to contact Daniel Gadd. We will have his contact information in the description below. And if you have any real estate purchasing information or other information about home buying, please do contact us. And thank you again for tuning in. And don't forget to subscribe to our channel. Bye-bye.